Hi, welcome to my channel where we provide an alternative view to the common narrative. Today I'm going to talk about the current banking crisis and the collapse of, yet three banks. So if you are interested, please continue watching. Hi, welcome back. Today I'm going to talk about the most prominent bank collapse that you probably heard about, and that is the Silicon Valley Bank, which collapsed on the 12th of March. But just for instance sakes, that wasn't the first bank that collapsed. Actually, the first bank that collapsed was on the 8th of March, and that was Silvergate Bank, which was also a cryptocurrency-based banking, or more focused on that market. And it basically experienced the same problems than the Silicon Valley Bank. And then a little bit later, the Signature Bank is also a bank that went into trouble and is currently went on a, I believe, voluntary liquidation. But the biggest bank basically was the Silicon Valley Bank. It had about assets of about $208 billion. And this is seen as the second biggest bank failure in the history of America after the 2008 crash. And funny enough, the Silvergate Bank is the third largest. Well, the question all happens is why, and the reasons are actually quite obvious. And that is interest. The interest rate are rising in America. There is significant inflation, and there is significant unemployment. Now, I've made a video about the so-called 500,000 jobs that were created in January. That was announced by the American government, but as I've pointed out, that is pure bullshit. It is fictional numbers, and I don't understand why anybody wants to believe these numbers. The tech sector is especially hard hit, and Facebook is letting go, say 10,000. Apple is going to do 10,000. Google is going to do 10,000. Twitter, TikTok, Amazon, they're all letting people go. And if you think about this, what is the biggest income for Facebook and, say, Google? And that's advertisement. And why, if they don't do the necessary revenue or reduction in revenue, and they are forced to cut costs, which they have already done, layoffs are usually the last option in a cost-saving exercise, and then letting these people know, then there is a clear reduction in revenue from advertisement. And if there is a reduction in revenue from advertisement, then there is a general downturn in the economic sphere. People don't have enough money to advertise because their turnover or their sales are deteriorating. Yes, I know it's the biggest mistake companies usually make, is cutting on their advertising budgets in bad times, but that is how, unfortunately, the human being functions, and that is what they do. But let's look at the reason why the Silicon Valley Bank, and it's not the only bank that is currently in this predicament. There are a number of different banks that experience the same problem. And the problem is as follows. I'm going to ignore fractional reserve currency banking. That's going to make it too difficult. So I'm going to stick just to a plain simple model. Banks, you go to a bank, you deposit your money, the bank takes that money, and pays you a small interest fee on that. Then they take your money, and then they have two choices. They either lend it out at a much higher interest rate to another entity, or they take this money and they invest it in other companies and on the stock exchange and on bonds, government bonds and stuff like that. Now, in the old days, it wasn't like that, especially after the Great Depression. The Glass-Steagall Act was created, which basically separated normal banking from investment banking, because that was one of the biggest reasons for the depression. So what it's all about is that at that stage, this Glass-Steagall Act basically prevented the banks to take your deposits and then speculate it and invest it in other vehicles. The only way that they could make any profits is by lending it out to another party, and only the money that they basically receive from deposits. Investment companies were separate entities that had to invest their own money or investors' money specifically for speculating on the stock exchange. So what do these banks then do? Well, the most conservative investment that the banks can make is in government bonds, because government bonds are basically, they are not insured, but governments don't really default on their loans, so they pay back their loans, so you cannot basically lose your money, so they are low risk. But since 2008, the Federal Reserve has had a policy of near zero interest rates, and they made so the return on any loans that were given to the government were basically pegged at very low interest rates, say 1 to 2%. So what they can do is banks, they can borrow money at 0% and then lend it back to the government for 2% in the form of a bond. The banks are buying the bonds, and then they make a 2% nice profit. But the interest rates do change for short-term bonds and long-term bonds and so on. So there is a spread of interest rates problems. And this whole method was created in order to stimulate the economy and bail out the banks. But unfortunately, matters have changed. We all know that. After COVID, a lot of money was printed. And the printing of this, just too much money, excess of $7 trillion that were basically printed during the 2 years of COVID. That is just too much. They overstepped the boundaries. And they flooded the market with capital and cash and so on. And then there were supply line problems, and then there were shortages of certain goods and chasing money, and inflation started to go, and suddenly sectors that were not dependent on the supply chain also raised in the prices and contributed to the whole matter of inflation. And then we had the Ukrainian war and the self-imposed sanctions, and that making it even worse. And well, now we have 10% and more inflation in the Western world and America as well. And don't be confused with the official numbers. The American government is well known that they lie about their numbers. You've got to dig a little bit deeper. You can talk to private people there. They all experience much more than 7% or whatever the official interest rate is. Now, just for interest sakes, so if you say you borrow $100 and you have to pay, say, 5% or 4% interest on that, or you get 4% interest on that. So you get, after a year, you get $4 more. So that's supposed to give you the same purchasing power. You can buy the same goods if the inflation was also 4%. But unfortunately, inflation is 10%. So you're actually losing $6. So you can buy $6 worth of goods less in a year's time than what you can buy now. So basically, that is what they call negative interest rates. You are losing money if you are depending on interest rates. The problem is also that when interest rates climb, then the value of the bonds decrease. So say that you get a bond, you pay $100 for that, so the face value is $100, and for that you will earn, say, 2% interest. But say the interest rate climbs, then the government cannot issue a bond for $100 at 2% interest rate. It has to do it at, say, 4%. The current rate is 4.75, if I remember correctly. So basically, the value of that bond that you paid $100 and gets 2% interest is now worth less. So if you want to sell that piece of paper to your friend or to somebody else, he's not going to pay $100. He's going to pay a lot less, because the value, he can buy $100 and get 4% interest instead of buying your $100 and getting 2% interest. That's more or less how it goes. Now, what the problem is that because against popular belief, all the bullshit that the American government is talking about, the revitalization of the American economy and everything is going good with that, which is a total farce and lie, when people, big companies, the tech companies, which are actually driving companies behind the American economy, except the oil at this stage, the oil and gas ones, and the military-industrial complex, but they are not the whole American economy. High-tech plays a big role. Now, the high-tech companies have basically laid off people. Now, what has happened is that, number one, the people that are employed at these high-tech companies earned a salary. And that salary was then deposited, let's call it, in the only bank now, the Silicon Valley Bank. And therefore, the Silicon Valley Bank received money, which it then could technically in the old days invest. That is what it has done. Also, the tech companies made a profit and deposit all their surplus money or their venture capital financing or whatever extra money they had in the Silicon Valley Bank. So that was like a positive bank balance. And therefore, Silicon Valley Bank took that money and invested it. Well, with the downturn in the economy, people are fired. So less people get salaries, and therefore less salaries are deposited in the Silicon Valley Bank. Also, the companies, the reserves or the money that they had, operating money, is now getting less because they are getting less income. That was the reason why they retrenched a lot of people. So now they are eating up their positive bank balance, and that is getting slower. And that is called actually the withdrawal of cash deposits from the bank. And this has happened to all three of these banks. Because the interest rates were rising, business was slowing down, less deposits due to layoffs and to eating up the positive bank account. But unfortunately, they took the money and they invested in bonds. So now what they have to do is they have to sell those bonds in order to pay out the money to these people that withdraw their salaries or use the money for the operation of the banks. But because the interest rates have climbed, the value of their bonds have deteriorated, and they're making a huge loss on the initial investment. And that means basically insolvency. They cannot sell all their money, all the investments, at the one-to-one ratio as they did initially. So they paid for it, they got a deposit, $100, bought $100 of bonds, but only get 80 back. And this guy wants his 100 back, so somewhere they have to find another $20 to make up for the 100 to pay this guy back. And that is basically what is happening. And this was all predictable. And this has not happened last week, the 12th of March or the 8th of March. That has been coming on for a couple of months now. And basically everybody in the banking system knew that. And the Reserve Bank also knows that. But now the Reserve Bank or the financial departments, I'm not sure how it goes in America, but there are so many institutions. Some of the financial banking authorities grabbed in took the Silicon Valley Bank's assets, and they now are going to auction it off. Okay, sorry. In America also, you got insured deposits. So the people that take it to the bank and put it into the savings account, that money is always guaranteed by some of other insurance corporation. But not all the money that is in the bank accounts is insured. So some of the people that have made deposits, those are not insured. So if the bank goes belly up, they will lose their deposits. But the American authorities, whoever that would be, grab the bank and then guarantee that everybody depositors will get all their money back, even the uninsured. And the uninsured at this stage is about $174 billion. So that has to be given from somewhere. And what the authorities decided is they're going to basically auction off the bank and then take the assets or the income from this auction and then pay back for the depositors. That is basically, they're not going to use tax money, payers' money like bailing out in the old days. That's more or less they're going to do. But they also said that any bank that becomes in trouble can lend from the Reserve Bank any amount that they want. It's basically an open checkbook. If a certain bank is in trouble and they need $100 billion, then I call it the Reserve Bank, but whatever that or the Treasury, I don't know. I get so confused with these idiots. They're gonna lend. I think it's the Reserve Bank gonna lend the money to that bank, so they're gonna create it. So what they're doing is they're creating again money out of nothing, giving it to this failed bank, bailing it out as a loan, which is fine, but they're increasing the amount of money in circulation in a time when there is high inflation due to the excess of so much cash in the market. So what they are doing is they are then increasing the inflation rate. But in order to increase the inflation rate, they have to raise the interest rates. And the more they raise the interest rates, the more banks will come into trouble because the bonds will be less value than what they paid for it. But people will withdraw their money because they need their cash because it's going bad in the general industry. So $100, $80, where's the $20 coming from? Where? The Reserve Bank. The Reserve Bank. From this loan. Unlimited. That means the Reserve Bank is prepared to print unlimited money. And that is a dangerous sign, because that will only increase inflation. So you can see they are in a catch-22. If they do this, it goes wrong. If they do that, it goes wrong. Then this goes wrong. And vice versa, you know? So there's some big dark clouds gathering in America. And although the government has said they have contained it, nobody's sure because nobody knows what the real impact it will have on the other banks. We do not know what the state is of the other banks, their financial positions. We do not know what their client basis is and how the client basis is basically weathering the storm in the economy. I mean, they're already predicting a recession in America. I think it's the second or third quarter. So there's a downturn in the economy. But magically we have 500,000 job creations. But anyways, there's already sign that it might be spill over to the European banking system as well. And we are talking here about Credit Suisse. This is a Switzerland bank. And the Switzerland bank has also been warning for the last couple of months that their depositors are getting less. That means people they use more of their cash, withdraw it out of the bank in order to finance their business, or people don't earn a salary, so that money is also gone. They're withdrawing it to make a living. So the banks has to sell off their assets at a loss in order to finance these withdrawals. Due to high inflation, due to high interest rates, due to fixed bonds fixed interest bonds, long-term bonds, lower interest rates. You know, short-term bonds, short-term loans for the government is very volatile in terms of interest rates, but the long terms are usually much lower, depending on how they see where the economy will be in, say, 10 years, a 10-year bond and so on. So we are already seeing crack in this Credit Suisse bank, and I know that a lot of banks, through the years, couple of last years, couple of previous years, say, for the last 3 or 4 or 5 years, the European banks have already been in trouble, especially the Italian banks. And if you think about this, we have this huge inflation right over Europe. We have a possible recession in Germany with the narrative that German economy will collapse, deindustrialize, energy prices are going through the roof. Well, if you want to follow that narrative, then it doesn't look good. There's going to be a run on the banks. People need their money, and then the money don't have it. The banks don't have it, and then they have to sell their assets, their bonds at low prices. Who wants to buy it? Market doesn't want it because they don't have the cash. Everybody's in the same boat, and then we have the huge crash. And isn't that one of the hidden possible reasons for the Ukrainian war? Not containing Russia and the military aspects, but hiding a financial collapse which will result in a reset, a financial reset, getting rid of about 280 trillions worth of derivatives in the market, which are, those are like all the nuclear bombs in the world combined and then multiplied by 10, and then you won't even get to the impact that those derivatives will have on the world economy. That's why I always said, maybe there's a whole different reason, because from a military point of view, the war in Ukraine doesn't make sense. The fact that nobody really, they all wanted it, they all were preparing it in terms of instigating it, but nobody prepared the weapons and the ammunition to supply it and to fight the war. So I was looking for trouble with the kid on the street, on the block, and without training or making any effort to prepare myself for this big fight. And that is the thing that I always worry about. But I always say that the financial system in the West is totally on a tripwire. And here we see the first signs. And this is not going to stop tomorrow. Interest rates will still rise. They have to rise in order to contain inflation. But inflation is artificially high. And it's going to be getting worse because of, yes, not only sanctions against Russia, but all this attitude of sanction everybody. Sanctions are a two-edged sword. Not only do you deny the victim of the sanctions of a certain product, you also deny your own company an income because of the sanctions. Therefore, it has an influence on your economy. Doesn't matter how you look like it. If you can, your factory cannot sell it to item A to person A due to sanctions, then he has to sell it to person B. But that is person B is already serviced by a competitor, and now you don't know if you're going to be able to sell it to person B. And if you do it, then you're going to sell it probably at a much reduced price or at a loss just to get the business. So this is no straightforward, straight line, easy, simple circumstances. There are enormous amounts of factors that influence the whole decision. So watch out. Keep the news. Watch the news. See how it's going. There's a little bit going to be a quiet now. Maybe then a week later, then we're going to hear some more. And so we'll go for the next couple of months. We will hear. And hopefully it doesn't go like snowball out of control. But 3 banks within 4 days, that is significant. With a possibility in Europe, in Switzerland, that's also significant. In any case, that's my story for today. You like what you heard? Haven't heard? Subscribe, tell your friends to subscribe. Leave a message, press the button, like button, press the notification button. You know all those other stuff in any case. So until next time, cheers.